Welcome to the Two-Handed Economist. I'm John Diamond from Rice University's Baker Institute. This show gives you what a one-handed economist can't, both sides of the argument. We're not here to repeat sound bites. We're here to give you the full picture. Today I want to talk about two problems that look separate, but really aren't. The first one is sitting in plain sight. The United States government's budget and balance sheets are in terrible shape. The second is the one building more quietly in the background. Private credit troubles may be looming in a part of the financial system that is big, fast-growing, and still not very transparent. And here's the connection between them. If the next financial problem hits at a time when the federal government is already buried in debt, deficits, and unfunded promises, Washington is not going to have the same room to respond that it had in 2008 or 2020. That is the real issue. This is not just a story about red ink in Washington. It's also a story about fragility, fiscal fragility, financial fragility, and a country that is pretending both can be ignored at the same time. Let's start with the federal books. The Treasury Department's latest consolidated financial statements show a government with about $6 trillion in assets and nearly $48 trillion in liabilities. That means the federal government is sitting on a negative net position of roughly $42 trillion. That hole got worse by more than $2 trillion in just 1 year. Think about that. In a single year, the government's overall financial position deteriorated by more than the annual output of many major economies. Another way to think about it is its financial position deteriorated almost by the size of Texas's economy. And that official balance sheet is actually the less scary part of today's story, because those numbers don't fully include the massive long-term promises built into programs like Social Security and Medicare. Those show up elsewhere in the government's financial reporting. And when you include those long-term, unfunded social insurance obligations, the scale of the problem gets much bigger. The 75-year unfunded obligation jumped to about $88 trillion. Put that together with the official liabilities, and total federal obligations are now worth $136 trillion. That's not a typo or a misstatement. That's trillion with a T. And I think a lot of people about this time start to tune out when they hear numbers like that, because trillion-dollar figures don't feel real. They're too abstract. Steve Hanke and David Walker simplified this in a brilliant way that everyone can understand, in a way that makes it more concrete. Take the federal government and scale it down into a household budget. They did this by simply dividing all the numbers by 100 million. After doing that, you have a household that earns $52,000 a year, spends $73,000 a year. It uses debt to fund $21,000 of its expenditures each year, and it has a little over $60,000 in assets. Oh, and it owes $1.36 million. No one would look at that household and call it healthy. No one would say, well, let's just let it ride for another decade and see what happens. Yet that is basically what we're doing at the federal level. And what makes this worse is that these are not just cyclical deficits. This is not a one-off crisis. This is not a wartime spike, although we may be layering that on top as well at the moment. The federal government has run deficits every single year since 2002. This is structural, chronic, baked in. Washington is not borrowing because it hit a temporary patch of trouble. Washington is borrowing because the entire system is built around promises and spending commitments that are larger than the revenues coming in. And now the interest bill is becoming its own monster. Interest on the debt has exploded. The government is now spending around $1.2 trillion a year on interest alone. That's money not going to defense, not going to infrastructure, not going to tax relief, not going to tax reform. It's just the price of past consumption. So when people say that debt does not matter, or that we can just keep rolling it over forever, that is not serious analysis. Debt service is real. It crowds out other priorities, it makes budgeting harder, and it leaves the country more exposed to interest rate risk. Now add another ugly fact. The GAO has once again refused to give the federal government's books a clean audit opinion. This is the 29th consecutive disclaimer of opinion. 29 years. Think about how absurd that is. If a public company went nearly 3 decades without being able to produce auditable books, people would not shrug and move on. It would be viewed as a scandal. But with the federal government, it's become background noise. The biggest problems are familiar ones: the Defense Department's accounting failures, the inability to properly track interagency transactions, and continuing weakness in how the statements are prepared in the first place. So this is not just a government with weak finances. It's a government with weak finances and weak bookkeeping. That's a bad combination. And while all of this is happening, the government also bleeds enormous amounts of money through improper payments and outright fraud. The scale is staggering. We are talking about hundreds of billions of dollars a year based on some estimate. Again, not small mistakes, not rounding errors, real money. So when people hear calls for a serious fiscal conversation, that should not be controversial. It should be the bare minimum. Now here is where the story shifts, because as bad as the federal books look, there's another vulnerability building in the private financial system, and it matters precisely because the government is already in such weak financial shape. The vulnerability is private credit. Private credit is basically lending done outside the traditional banking system. Instead of a company getting a loan from a bank or issuing bonds in public markets, it borrows from private funds, direct lenders, business development companies, and similar vehicles. This market has grown dramatically over the last 2 decades and went from being a niche corner of finance to something approaching a $2 trillion market. Why did it grow so much? Part of the answer is simple. After the financial crisis, regulation made it harder and less attractive for banks to make certain kinds of riskier loans. Finance being finance did not stop, it just migrated. Private credit stepped in to fill the space. And in some ways, that is not automatically bad. Private credit can be flexible. It can finance companies that public markets overlook. It can be a useful source of capital. But the risks are still there. The market is less transparent than traditional bank lending or public bond markets. It is less liquid. Its assets are often hard to price. And because these loans do not trade openly the way bonds do, managers often rely on internal models to value them. That is where things start to get uncomfortable. In a benign environment, model-based valuations can make a portfolio look stable. But stability on paper is not the same as stability under stress. A loan that looks fine in a spreadsheet can look very different when borrowers start missing payments, refinancing windows close, and investors suddenly want their money back. And we're starting to see some of those warning signs. There have already been a handful of cracks in this space. Firm-specific troubles, asset markdowns, gated withdrawals, stressed borrowers, and payout cuts. None of those incidences alone proves a systematic crisis is coming. But together, they suggest this is not a market that has been seriously stress-tested in a way that many people assume. That is the key point. Private credit became huge during a period when money was cheap, liquidity was abundant, and the policy response to shocks was aggressive. We still do not fully know how this market behaves in a harsher environment where rates stay elevated, defaults rise, recoveries disappoint, and investors lose patience. And despite all the talk about private credit being outside the banking system, banks are not cleanly separated from it. Banks provide lines of credit, they finance vehicles, they're tied in through multiple channels. So if private credit gets hit hard, the spillovers do not stay in a neat little box labeled alternative finance. They can move outward. And that brings us back to Washington. The reason private credit matters right now is not just that it might be vulnerable. It is that it might be vulnerable at exactly the wrong time. If something in private credit breaks in a bigger way, policymakers may once again feel pressure to step in, backstop markets, provide liquidity, and soften the blow. But that playbook assumes the government has room. It assumes the public balance sheet can absorb another emergency. That assumption is much less safe than it used to be. A government already running enormous deficits, paying more than $1 trillion a year in interest, and sitting on gigantic unfunded obligations does not have an empty balance sheet space waiting to rescue the next overgrown pocket of leverage. That is why these are not separate stories. The budget problem is not just an accounting problem. It limits future options. The private credit story is not just a niche Wall Street story. It is a potential stress point in a financial system that may once again turn to the state when things go bad. And if both of those truths are real at the same time, then the country is in a more dangerous position than most people realize. So what should happen? At a minimum, there needs to be an honest fiscal reckoning, not another performative fight, not another commission designed to produce a report that everyone ignores, a real reckoning. The federal government needs a credible long-run strategy to deal with spending, debt growth, and entitlement obligations. It also needs better financial controls, cleaner books, and less tolerance for waste, improper payments, and agencies that cannot pass an audit. And on the financial side, regulators and markets need to take private credit seriously before a bigger stress event forces them to. More transparency would help. Better understanding of interconnections would help. Less fantasy pricing would help. What definitely will not help is pretending the market is too private to matter or too sophisticated to blow up, because history says otherwise. We're very good at discovering that a pocket of finance was systematically important only after it starts failing. So let me close with this. The United States has a budget problem that is no longer a distant warning. It is here. It is in the numbers. It is in the debt. It is in the interest bill. It is in the government's own financial statements. And at the same time, there are private credit troubles looming in a corner of the market that's grown rapidly, stayed opaque, and has not really been tested in a truly ugly economic cycle. So the U.S. balance sheet is weakening while the financial system may be incubating its next stress point. And the worst possible setup is obvious: a government with no fiscal room meeting a financial system that suddenly needs to be bailed out. This is not theory. This is not direction of risk. The books do not lie. So what are some potential solutions? What can we do about it? The first step is that Congress needs to stop pretending this problem will fix itself and start forcing a real public reckoning. That is why one of the first legislative steps should be passage of H.R. 3289. It is the Fiscal Commission Act, backed by Bill Huizenga and Scott Peters, and it would create a bipartisan, bicameral commission to put forward recommendations on taxes and spending and educate the public on the choices involved. GAO has continued to say Congress and the administration need to address the government's unsustainable fiscal path. A fiscal commission is not a magic trick, but it's at least a real mechanism for forcing the facts, the trade-offs, and the hard choices into the open. The second, more aggressive step is Congress should call for an Article 5 convention limited to proposing a fiscal responsibility amendment to the Constitution. This resolution was introduced by Representative Jody Arrington of Texas, the current House Budget Chairman. It's aimed at bringing some sense to an otherwise crazy financial situation. And the model here is similar to Switzerland's debt brake, which is designed to prevent chronic structural deficits while still allowing deficits during downturns and requiring surpluses in stronger periods. In other words, the idea is not crude austerity at all times. The idea is discipline over the business cycle. And it's a great idea, one that America should examine in full detail. Now, whether you agree with every detail of that approach or not, the underlying point is hard to dodge. The country needs rules, institutions, and constraints strong enough to stop endless drift. Because what we have now is not serious. It is a government with terrible books, chronic deficits, rising interest costs, and political incentives that reward delay. So I will leave you with this. If your household earned $52,000 and spent $73,000, owed more than $1 million, and your accountant refused to sign off on your books for 29 straight years, would you call the situation stable, or would you call it a crisis? That's it for this week's episode of the Two-Handed Economist. Thanks for tuning in. The Two-Handed Economist is a production of the Baker Institute for Public Policy, recorded on the campus of Rice University in Houston, Texas. If you like what you hear, leave us a review. It helps other listeners find this show. Until next time.